Well, I guess it's official. The stock market has no idea what the heck is going on out there. The Federal Reserve, they made their first interest rate cut this morning since the early days of the COVID-19 pandemic. They lowered rates by 0.5%. Take a look at this chart. Actually, I'm going to show you 3 charts here. Look at this first chart. Within seconds of that rate, the stock market spiked up. These are the major US markets. Look at that spike. Now, in the ensuing minutes, look what happened. It came right back down. It's a little slower than going up, but look what happened. And then at the time I'm filming this video, there is about an hour or so left in trading today. Look at what's happening here, going up and down like crazy. Investors have no idea what is going on. Now, what happened with this cut, the Fed has lowered the benchmark rate now to between 4.75 and 5%. They made the biggest cut that they've made now since the 2008 financial crisis. If you set aside the emergency cuts that they made in COVID, I'm not going to factor that in here. They are trying to prevent a slowdown in the job market. And even though inflation's still above that 2% target, they still have to balance that act. It is that proverbial balancing act. The Fed also hinted today that there are more cuts to come. They plan to lower rates by another 50 basis points by the end of the year. The committee said that they made the decision in light of progress on inflation and the balance of risks. Now, not everyone on the board agreed. Governor Michelle Bowman, she voted for a smaller rate cut, 25 basis points instead. But the most important member of the team, Jerome Powell, he explained that they are concerned about the labor market. Even though unemployment is still slow, hiring has slowed down a lot. As recently as July, this shows how unpredictable this is. As recently as just a few months ago, Powell had said a 50 basis point cut was not something we're thinking about right now. But that came before the updated projections that unemployment in the US will now hit 4.4% this year. All that said, the economy overall is doing pretty well. We're seeing strong consumer spending, solid GDP growth. From a global perspective, the Fed's decision probably, most possibly, will have influence on some of the other central banks. We've already seen some of them start to cut. Right here in Canada, we've seen 3 rate cuts. Also, we've seen cuts coming in the UK. So we're probably going to see more cuts like this in other developed countries as well. I do want to talk about the cut today and say, is this a good thing or is it a bad thing? And as usual, it depends on who you ask. There are a few things, though, that I think we need to consider. First off, is this larger cut than a lot of people had expected a red flag? Is the central bank more concerned about the economy than maybe they've publicly acknowledged? They did point out to this slowing job gains, rising unemployment, but I wonder whether this 50 basis points cut, which is double than what a lot of people had anticipated, suggests that they may be seeing risks on the horizon that aren't fully reflected in the current data. They may be preparing for that. When we look back over history, the larger cuts tend to happen when the Fed expects some significant economic downturns or shocks. What we're seeing right now could indicate some underlying issues in the labor market or some broader economic slowdown that the Fed is taking steps to preempt here. Another thing I wonder is that by making these larger cuts, the Fed might limit themselves for further reductions if these economic conditions deteriorate further. We all know this, probably interest rates is sort of a key tool for stimulating growth. But the Fed funds now, they sit in that 4.75 to 5% range. So a few more cuts would take rates back to these near historic lows that we've seen over the last many years here. So if we get into a situation where we see recession, another major crisis hits, the Fed might have less flexibility to act. That would force them to rely on some less conventional tools. Who knows if we get there? And a third thing, inflation, yes, it has been easing. It is still above that target of 2%. So there is a risk here that I see if they are too aggressive, they could reignite inflation if demand in the economy picks up too quickly. Lower interest rates, typically that will boost borrowing, spending, that could drive prices up higher. I'm not saying here that I'm predicting any of these things necessarily, but it sort of is a reminder of this careful balance that they need to act here between supporting the growth and controlling inflation. These large cuts might just be a situation where they tip the scales in the wrong direction. So we now know that interest rates will be going down. We saw the 50 basis point cut this morning. It's just a matter now of how much further they'll go and how fast. With this environment as a background, rate-sensitive Harvest ETFs, they hit a 52-week highs back in August, and further rate cuts could continue to benefit the lineup. I want to mention 3 funds specifically that would benefit from this type of environment. First off, the Harvest Equal Weight Global Utilities ETF, ticker is HUTL. Utilities typically will benefit from rate cuts, and this is due to the lower borrowing costs, which bring in higher profitability potentials for dividend growth. Also, the Harvest Global REIT Leaders Income ETF, HGR. REITs are highly sensitive to rates because they often carry large debts. So when you have the lower rates, it reduces the borrowing costs. That makes real estate investments more attractive compared with fixed income. And thirdly here, the Harvest US Leaders Income ETF, HUBL is the ticker there. When we do see these lower rates, that can compress the net interest margins and that can stimulate borrowing and further economic activity. And that benefits the banks, obviously there through increased loan growth and financial transactions. Now you can learn more about Harvest ETFs. I will put a link to each of these funds in the description of this video. Big news from the telecom sector today. Rogers Communications, they've announced that it will be buying out Bell's 37.5% share of Maple Leafs Sports and Entertainment, MLSE, for $4.7 billion. And this will boost Rogers' ownership of MLSE now to 75%, with Kilmer Sports holding the remaining 25%. Now, as a reminder, MLSE, they own some of Canada's biggest, most prominent sports teams. This includes the Toronto Maple Leafs, the Raptors, the Argonauts, and Toronto FC. Tony Staffieri, he's Rogers' president and CEO, and he commented on the strategic significance of this deal. He said, MLSE is one of the most prestigious sports and entertainment organizations in the world, and we're proud to expand our ownership of these coveted sports teams. This purchase values MLSE at $12.53 billion, and the deal is expected to be finalized by the middle of next year. Now, Bell has been struggling quite a bit lately. They're saying that they're planning to use the proceeds of this sale to reduce debt, to shift its focus from telecom to technology. In fact, CEO Mirko Bibic says, today's announcement demonstrates that we are focused on creating the financial flexibility to support our ongoing transformation and core growth drivers. For you sports fans, it's important to note that Bell has secured long-term content rights for both the Maple Leafs and the Raptors for their games on TSN. For Rogers' part, they say that the acquisition is not going to affect its debt leverage. It will use private investors for the most part to finance the deal. In Canada's financial sector, Wealthsimple is celebrating its 10th anniversary, sharing some big news today. The company has now become profitable. Revenue shot up 88% over the last year to $129 million, and assets under management have doubled to over $50 billion in the last year alone. CEO Michael Katchen, he credits the growth to their expanded services, including their latest addition, which is mortgages. Now, Wealthsimple, it started off as just a simple robo-advisor and has added more and more tools over the years to become a real competitor to the sort of more traditional banks. They now offer commission-free trading to tax services, and Katchen says that their growing list of offers helps create a deeper relationship with our clients and leads to a more diversified, resilient set of revenues. The platform now has over 3 million customers. Now, as is the case with most businesses, this hasn't come without a few hiccups along the way. One of the biggest ones, Wealthsimple in 2022 had to cut about 13% of its staff, and it sold off its U.S. business to Betterment back in 2021. Still, the company is focusing now on its Canadian customer base. It's seeing steady growth in areas like wealth management, brokerage, and banking. Katchen also updated analysts with the company's future plans, and he went back and said that they originally had wanted to hit the $1 trillion in assets mark within 15 years. They're now 10 years into it. They're giving that a little bit more time. They're now aiming for the 20-year mark. He says, we're not done yet. We have a long way to go. He also hinted at plans to launch more credit products and even dive into insurance before too long. It is really nice to see such a great story right here in Canada. That is a wrap for today's program. As always, I appreciate you watching. We'll see you in the next video.